Trend filters can often mean the difference between a successful trading strategy and a failing one. Today, I demonstrate the implementation of a simple trend filter into an Ichimoku trading strategy. Stay tuned. Darwinex is a UK FCA-regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. If you're a talented trader looking to attract investor capital to your strategies, Darwinex is the fastest way for you to do this. We enable traders to raise third-party investor capital and then charge success fees on high watermark profits. Additionally, Darwinex itself invests in its traders with our seed capital allocation program that allocates up to 90 million euros per year in successful trading strategies. So, if all of that sounds interesting, learn more by clicking on the link here, or you can find further links in the description right below. Now back to today's tutorial. Today I look at a trend filter that is widely documented and considered by many as a de facto rule for Ichimoku strategies. But in reality, does this pass the test and improve results? Let's find out. We're now well into the implementation of the Ichimoku strategy as part of the Spotlight on Indicators series. So if this is the first video you've seen, you might be interested in going back and looking at some of the episodes covering the initial implementation, and there's a link in the video description that will take you to all of those episodes. In the previous episode, we looked at adjusting the level of risk associated to each trade, and the blue equity curve here represents 1% risk of equity on each trade, whereas the yellow curve represents 0.25%. And we discussed the nature of linear equity growth and exponential equity growth. However, I did indicate that for this blue curve, the drawdowns are simply too large for my personal risk appetite. And so for me, I would need a much lower risk than this, or indeed do further work on the strategy to improve the smoothness of the equity curve. And so the topic of today's episode, which is the implementation of a trend filter, is one of the ways that I'm going to look at to potentially improve that smoothness. So let's take a look at how this particular trend filter works. Generally speaking, with the Ichimoku indicator, if price is above the Kumo or the Ichimoku cloud, then that shows bullish sentiment. If the price is below the cloud, then that is bearish sentiment. And so it's this principle that I'm going to use to determine the rules of the trend filter. And so if price is above the Kumo, then long positions will be allowed, but short will not. And vice versa, if the price is below the cloud, then short positions will be allowed to open, but long positions won't. Now, if you remember previously when we implemented the stop loss strategy, for a long position, we were setting the stop loss at the bottom of the Kumo here. And for a short position, we were setting it at the top. And as part of our implementation, we also performed a check to ensure that the price for a long position was above the stop loss. Because obviously, if we didn't do this, we'd have an invalid stop loss, which was on the wrong side of price, and that trade wouldn't be allowed to open from the trading terminal. And so, in one respect, we have actually started to already implement a trend filter just because of that simple rule. So, for a long position, it would not be allowed if the price was below the Kumo. So we're already halfway there. In order to implement this new rule, which is that the price must be above the cloud for a long position, we simply need to make that criteria a little bit more stringent and say that the price must be above the top of the Kumo. So we already have the rule in code, we just need to slightly adjust it. And so we're now going to say price must be above the Kumo to allow a long trade to execute and must be below to allow a short trade to execute. So let's now return to our code and make those adjustments. So you can see that this is the rule here for a bullish crossover, which of course would result in a long position. And we're using currently this condition here, where we're saying that the price must be above or greater than whatever is the minimum of the Senku span A or the Senku span B. And these are the two lines that provide the boundary of the Ichimoku cloud. And so now for a long trade, instead of looking at the minimum of those two values, we're going to change this to look for the maximum, i.e. the top of the cloud. And vice versa, for a potential short position, we were making sure that the price was less than the upper value of the cloud using the mathmax function, and we're now wanting to make sure that it is below the cloud entirely, and so we're simply going to change this to the mathmin function to look for the bottom of the cloud. I'm just going to make sure my comments are all up to date as well. So now we're checking that the price will be above the Kumo for a long trade and below the Kumo for a short trade. And that's it. We've now completed the required change in the rule to fully implement this trend filter. So we just now need to compile, and we can test that in the strategy tester. So we'll come back in a moment when that test has completed. Okay, so that has now finished, but in order to see the effect that the change to the trend filter has had, it's best to look at the two results side by side. So the yellow results here show the previous equity curve without the change to the trend filter, and then the green line with that change. So there's a few things to consider here. Firstly, the yellow equity curve here obviously ends up with a higher level of equity, but that doesn't necessarily mean that that strategy is better, because we also have to consider the downside risk aspects as well. And if we take a look at some of the drawdowns here, we can see that they are significantly smaller for the green curve. So for example, if we look at this drawdown here, the drawdown is much more severe on the implementation without the Kumo filter than it is with. Likewise, we have another major drawdown here without the filter, which is reduced significantly here. So when using the filter, this in many respects produces a more stable equity curve. But I always like to quantifiably measure these, and so as I've said before, my preferred metric is the compound annual growth rate over the average drawdown. And for the yellow curve here, this produces a value of 1.086. And for the green curve, it actually is very similar, just slightly less. Now, it's worth noting here that there possibly isn't as big a difference with the trend filter as we might have expected because of this fact that we'd partially implemented the trend filter previously anyway when we performed that check for the stop loss. So there we were ensuring that price was above the bottom of the Kumo in order for us to not get any invalid stops. So we were already filtering out all of those where the crossover happened below the Kumo. But it does appear that the slight change in the level of our check to fully implement the trend filter doesn't have a significant impact. So what does that mean? Well, it means that when the crossover did occur within the Kumo, that still, on the whole, produced profitable trades. Now this goes against what the general consensus is that you read in books and on the web about trading when price is inside the Kumo. Generally, the vast majority of literature says that you should avoid trading in those situations. But I'm a firm believer in you can't believe everything you read, and I always want to test these things out for myself. And based on these results, it looks like trading when the price is in the Kumo produces actually quite similar results to when it's on the correct side of the Kumo. Now, which one of these would I choose, the yellow or the green? I'm really not sure. I think I would go for the green because of the massive reduction in some of those drawdowns. But if you kept the trend filter at the previous level, which was on the opposite side of the Kumo, that still produces quite good results. Okay, so in the next episode, I'm going to move on to an alternative type of trend filter that uses the Chiku span line of the Ichimoku. And we'll be able to compare and contrast how that works compared to the trend filter that we implemented today. And this will bring us to the end of the simple implementation of Ichimoku that I'm going to look at. But if you are wanting to pursue this further, there are plenty of other things that you could implement. So the first being, for example, alternative stop losses, such as trailing stop losses. And you could also look at doing a sensible optimization of the parameters. And if any of you choose to do that, then please do share your results in the comments. But in order to help with anybody wanting to build these strategies into an algorithm, I'm next going to do 2 episodes specifically on the coding techniques that I've used. The first of these, episode 18, will look at the CI Ichimoku class. And this is a class provided by MetaQuotes themselves that allows the implementation of certain indicators, including Ichimoku, to be much easier. And then in episode 19, I'm going to specifically look at the coding of the crossover capability, because this is slightly different to a standard crossover that you might code between, for example, 2 moving averages. And I covered the reasons for this in a previous episode, but I'm going to look specifically at this in more detail and also provide the code that I did use for the crossover. If you think you have any relevant information, hints or tips about the topic of a video, then please remember to comment so that we can all benefit from your insights. Also, if you're getting value from the video series, then please remember to give me a thumbs up. Now, until next time, trade safe.